Good afternoon. Welcome to Green Bicep. This is week number 18 in May. So, what is happening this week? The Fed is meeting tomorrow and they're likely going to raise interest rates. Currently, the market per Bloomberg has priced in no rate cut as of today. So, we'll see how that plays out. As you can see in the last week or so, Hasbro, Chipotle, Meta have all performed extremely well. The markets continue to be in a chop because of the inverted yield curve. There's a equilibrium is not in place, and so the markets are in a chop. They're trying to find their place and understand where they need to go. That means price discovery. We'll be covering the Commitment of Traders report. It looks at liquidity in the markets. Most recently, Bitcoin's held steady around 28, 29K, and gold broke through 2K again today, while the banks all sold off hard. And inflation is dropping quickly, and prior I covered this, how when you look at the CPI excluding, just looking at core, excluding housing or shelter, it's actually under 4%. And we cover the Fed is meeting. Initial jobless claims will be talked about a lot over the next few weeks, and they're beginning to rise, but it's tepid. We'll look at that as well. Then the regional banks are under pressure, and lending has been decreasing. That makes sense with the regional banks under pressure. Lending will start to decrease. And we'll look at housing data as well. And next, let's look at the financial markets. As you can see here, across the financial markets, they have been off a little bit in the last day or so. But year to date, the market is up 7.92%. We're hanging in there. Year over year, we're about flat to up a little bit, depending on the index. The reason why I have this pointed out here is if you look at the S&P 500 at Dow, New York Stock Exchange, and NASDAQ, and you look at the internals, you can see we're starting to turn red here on a few of these. And historically, when you turn red, for example, if you look at the Russell 1000, we turn red and it shot over. So once we get a few more red bars, we're likely going to have a continuation of this decline that has started. Now, because of liquidity, it's making it harder for that to happen because the market makers are able to provide stability in the market and able to provide sector rotation without any pockets of losing a bid or ask, which would cause extreme volatility. So here, over the last 30 days, you could see what sectors have done well in healthcare, consumer staples, communication services. And then year to date, communication services and technology, they're all tech related, have done extremely well. The Metas, the Googles, the Nvidias of the world. Well, energy has really suffered and was off a lot today, and the financials as well. So, saying that, where do you want to look in the next, throughout the rest of the year? Is it likely that consumer or communication services is going to be up another 25%? It's unlikely. So during these periods of sector rotation, you probably want to go to quad 4 type investments, and I believe that's healthcare, utilities, more conservative. Now, if we were not going into a recession, then you would want to start to pick up some growthy type names, and they usually lead out. But saying that, I think it's too early at this point. But this is one reason the market has been held together so well. The Commitment of Traders report, it shows the open interest of different types of traders and ultimately how they're positioning themselves in the market. So if you look at this report and you see that it's an aggregate positive number, that means they have net exposure. So for example, the dealer, let's see, the commercials consisting of producers, merchant, processors, swap dealers, they're very aggressively have open interest. Well, down below in this financial traders report, the dealers are in red, and they are positive but trending down. But at the same time, you can see the asset managers, institutions are pushing up high. So it gives you a gauge of sentiment in a way. And seeing this expansion of the red line here and the green, typically you would think you would see a lot more contraction, like here what we saw when this turned over, and we're not quite seeing the contraction yet. So that just shows you this market might have more legs in it, just because of the stability of the financial institutions and the liquidity of them. So this market is ever more complex than those in the past that I've seen. So when you look at the Summation Index, it's looking at measures accumulated net advances in stocks in the stock market, specific to the New York Stock Exchange here. And down here you can see the S&P 500 drop down, and you can see right about here is when we got the Summation Index topped the black line, then the moving average, then it went down. And you can see a top here, and then you can see S&P turned down, the top here, the S&P went down. Now we're turning over again. So given this is such a slow moving indicator, it takes a long time to turn, the probability of it turning down is high, but because of the liquidity, it may not be so dramatic of a drop. The angle, like the slope of this at 45 degrees, and this looks like it might have been more than 45. Well, maybe we might get more of a bull type movement over the next 12 months to 24 months. That's highly probable. And so then looking next at the initial jobless claims, and this is a weekly report that tracks the number of people who have filed for unemployment the first time. So it's popped up a little bit recently, but the fact is it's just in trend of the economy. Here you can see I pull this in here as well because of COVID and how they shut the economy down. So it's a good reminder that the government has a lot of power, and that's why I think the Fed's not afraid. They're being aggressive because they realize they could shut an entire economy down and turn it back on and be okay. Meaning the government's okay. Not everybody within the economy is okay, but as a whole, it lifted together. So next, the PCE price index, and the Federal Reserve looks at this closely. It measures the average change over time in the prices paid by consumers for goods and services. And here's the month over month. You can see it. March was only 0.1, and so that's what we want to see. We want to see zeros, the 0.1s, the 0.2s. So month over month change is not great. So if you take that 0.1 and multiply it by 12, then you get an annualized number. So that's quite good to see 0.1. And then here you could see this is year over year. So year over year was up 4.2% year over year. But the rate of change is decreasing. It's no longer up 6%. Now we're at 4%. And then as long as this continues to stay stable, we'll eventually flatline. All right, so let's look at commodities. Normally I look at this at the very end. I look at prices, raw input prices of commodities, metals, and agriculture, you name it. And the reason why I'm doing it now early on is just to show that inflation is not as hot as everybody, at least for raising rates. So we got a lot of the metals are down quite a bit year over year from 60%. The high end is silver, which is used in some manufacturing. Steel down 30% week 5 for the month 12. So then looking at agriculture, you can see year over year almost 1, 2, 3, 4, 5, 6, about a half dozen items are actually up year over year, but a majority are down more than 10% year over year. Sunflower, wheat, butter down 35% year over year, milk 23, tea 12. So only we have potatoes and orange juice and sugar and cocoa are all the ones that are up, and rice on the food side. So on agriculture, inflation is coming down. You got livestock. We have live cattle, salmon, and more cattle. Only things up year over year. So it looks like, yeah, the meat, some of the meats might be expensive depending on how, but then you see beef, poultry, lean hogs all down year over year. 24%, beef 14. And then you look at this is, I put this in here because it has the CRB index, and that it was down 12% year over year, which is heavy in energy. And the Goldman Sachs commodity index down 16%. So inflation is coming down. And raising rates is not justified currently by the Federal Reserve based upon looking at this data here. Looking at Germany PMI, so the economy in Germany. The reason why I put this in here is just give a view of the world and how they're feeling there. And this is a economic health. It's basically a survey that provides the economic health for manufacturing and services. And you can see it's under 50 is considered contraction. It's at 44 and dropped down. So Germany is like one of the largest economy in Europe. Then you got France down to 45. You got USA, boom, we see, if you look prior, down, 4 down in 1, 2, 3 in a row. Then you have several in a row, then flat, improved 1, 2, 3 months, then down several in a row. But look at the US. Improve. So essentially what it means is those in charge believe things are getting better based upon what they're seeing activity, which is great. And we know in the United States, as well as a lot of around the world, the capacity utilization is close to 80%. So on the manufacturing side, much of the world is at capacity. So we will have supply issues with prices. That is not going to go away if demand picks up much. And so as populations like Indonesia and those areas where there's a lot more youth, as they start to grow up and have more money, then that's going to actually filter through the rest of the world economy, especially when you cumulatively you get into the billions of people between many countries. Private loans in Europe dropping off. So you can see Germany's economy is dropping off. France is dropping off. Sure enough, loan volume's dropping off. But this is private loans. But the point is that loan volume is dropping. And once you have commercial lending, private lending drops, and the economy goes with it. That's what happened in 1929. They cut off lending, and you can't run a business if you're growing a business and you want to continue to grow. You could get your cash from profit and reinvest it in, and if that's all you did, your growth rate would be a lot slower. So you borrow money, you open up another thing, and you have conservative growth. Now, looking at housing, the new data hasn't come out, so this is the latest and greatest. Permits is the thing they issue before building a house. And so year over year, single family, 1 unit, off 29% year over year. That's material. And I did some analysis prior, and it looked at all the housing and looked at what was started versus completed. And based upon my raw analysis, we have housing a lot greater than of what was in 2008, comparable to the 80s, 1980. So starts, you can see starts are down 27%, single family year over year. The only area that is up is multi, 5 units or more, up 6.1%. So that makes sense. They're going to squish more people into tight, smaller areas. Then over here, this little chart is looking at all starts. So that's 1.4 million, and that matches up to this 1.4. That is single family, 2 to 4. Then I'm calling this multifamily, 5 or more units. And then if you go regionally, you could see that the Midwest is off 44% in total. South is okay at flat. And then West is down 40%. And the Northeast is down 14%. Surprised the Northeast is doing so well, because historically when I used to look at this, the Northeast was always the weakest link. Under construction, same thing, down 11.8%. They're not issuing the permits, then they're not going to be under construction eventually. So you could see it filtering through. Then completions are basically flat to nothing. So you could see they're just not, they've been completing homes the same amount year over year. And then, so in conclusion, with housing, it starts being off 27%, and then 30 to 40%. That doesn't play well for the economy, because housing is such a, there's so many connections to the rest of the economy having to do with housing. And so then we get back to this PE of the market. So in 2008, the PE hit a low of about 10 right here, 2008, 10. In the crash of 2020, we hit maybe 11-ish. And 2011, wow, we hit 10. 2018, we hit 14. So, I mean, I think coming back to 16 does not seem that unreasonable in the mid 3,000 S&P, 3,000 something, if I'm doing this right. So it's, yeah, I had 30.75 as my target. I'm going to hold true to that, just because I think I think everything has to reset, valuations do, especially if they're going to keep the cost of capital higher than 0% going forward. And then here's the yield curve. Currently on the short end, you could get a 3-month bill and get about 4.5%, 4.65 or so. And then on a 30-year, you're getting like 3.5 or so approximately. So the yield curve is not natural. Normally when you go out in time, there's more unknowns, and so you get a higher interest rate. That is not the case here. They're saying the short term is more risky, which might tell you be careful if you're investing in the stock market, if the short term is more risky. Or you could say it needs more yield to put your money into it. So it's today it's saying, yeah, it's interesting. It depends how you look at it. But the fact is the yield curve is broken. And then post each one of these tops, the market did a nice adjustment, and I circled when the yield curve was inverted in green here. So we could see we may have an adjustment coming. I threw this in here because sentiment's so important. You can see that sentiment's been trending up for this Michigan. Inflation expectations did tick up, and that probably has to do with gasoline prices have gone up quite a bit in the last several, in April essentially. So that immediately is felt by people, or they see it, and it's just annoying. And then it's very annoying when you got to fill up a huge tank and it costs extra $20. Lending, I didn't update this, but it was starting to turn over, and with the banks going bust or just being acquired by other institutions like JP Morgan and First Republic, their equities are going to zero. Lending, brand awareness, all their reputational capital is affecting those banks. And yeah, so we should expect lending to continue to drop off. And that's another reason the Fed should not raise rates. And raising rates raises the cost of capital, which initially causes inflation. So here's commercial lending. This is updated and it is dropping off. I pulled it back just so folks you could see prior to 2020 crash, COVID, it was dropping off too. So COVID, we were going to have a recession here, and COVID just kind of threw it off a little bit. And I wanted to keep this Restrict Act in here because the Restrict Act is taking away privacy for those that are online. So if you care about your privacy, read about the Restrict Act. And this is back in here, the HOPE acronym by Michael Kantrowitz. And the reason why I brought it back in is because the earnings are probably about 3/4 through. And how are they doing? So earnings overall have been coming in okay. A lot of guidance were issued down prior, so that has cushioned it for this quarter. But so let's go to the next slide. You can see that Q1 earnings, blended growth rates are off in materials, healthcare. You can see those weaker areas. Then you can see the revenue it looks a lot more consistent. But based upon expectations, everything's green. So if you actually look at actual earnings are not that great, but based upon expectations, they are. So you can see earnings are in red, while revenue is mostly green. So the easy way to simplify this is that the Fed raised rates, which made the cost of borrowing more expensive, which contracts capital for those companies that can't get it. It raises cost, and eventually it eats into margin. And so that's what we're seeing. We're seeing the margin get eaten into. The revenue side, they try to raise prices where they can to pass that on. And so revenue isn't so bad. Plus, on the earnings side, you got the cost of wages have been ticking up a little bit as well, and that's probably an issue. But big tech has been laying off, so they're trying to maintain their margin as well. Just like Pepsi laid off, then their stock hit a 52-week high. All right, here are the banks. So it's pointed at FRC, and they may no longer be. They are gone. They are gone. FRC is likely going to go away. Well, the brand will stay. CMA Co-America, they are probably in trouble. They're the weakest stock today amongst the group. PacWest was weak. Most of these guys were all weak. So the equity holders are the ones that are getting shafted here. If you have your money there, you're likely okay unless it's over the FDIC limit, but it depends because there's certain types of insurance you can get at a bank that you're covered over $250. And I'm not talking about a TD Ameritrade. I'm talking about a traditional bank. So that's worth asking. If your bank doesn't offer that, then go to another bank where you could get insured when you have $280K or whatever the number is. But it's in the low millions. You can be insured up to. This is dated, but now, So I think VLY is like around $6. Citizens is breaking down. I don't know if it's quite down there yet. They all just started breaking down today, actually. So it's like, if you get a bounce, it'd be a good opportunity to buy some puts. I don't know if we'll get a bounce. Tomorrow might be the day. You might get lucky and get a bounce because the Fed's meeting tomorrow. They sold it off today to shake the Fed up a little bit. And, should be really interesting. But the weakest ones have been Citizens. CFG has been one of the weakest, and CMA, CFG are the two I've been watching from a relative strength perspective. MTB was weak today, but it was the CMA, CFG, and they're all pretty crappy. FITB, HBAN. You should look at their balance sheets and add it up. They're all negative. Is Citi on here? Yeah, I added Citi's up. I won't even say how short they are. And it doesn't start with a T. Let's see. And I want to throw this in here because the Fed's balance sheet has been contracting. So the Fed has not been grown their balance sheet. So interestingly enough, there's a high correlation, and so the markets are less likely to do well in that situation historically. Saying that, what's likely to happen if they over tighten, which seems likely, we'll have to have quantitative easing or fiscal stimulus to get the ball rolling, in just like 2020 or 2008. Because, they've really overdone it, in my opinion. And I just kept this in here as a friendly reminder. Total debt per person is exceeding that of 2008 in certain areas. Yeah, then the Baker Hughes, we've flatlined and it looks like we found a bottom here. So this is a number of new rigs coming on or off, or just rigs in general. So everybody's, the oil people, I was listening to a few today in the last few days, and you could tell everybody's like not happy. Like, just the dialogue's not very constructive. But the play is over the next few years, because of the World Economic Forum and their initiative, they're telling countries not to explore for new oil. So oil is likely going to go up in price because of that, and OPEC needs to keep a certain floor in populations grow, and if they're not producing more oil, bringing it out of the ground, then prices go up. And based upon the experts I follow, this is likely in the next 2 to 3 years. Saying that, the market always looks ahead. That's why I think this year is the time to be buying certain names. Just slowly but surely. High quality. The Valeros of the world. So here we're looking at, I did update this as a commodity super cycle. Are we going to break into it? So this is us actually up here, the blip here, and we actually have come down to this line. So I think it's critical support here. That's why I put the green line in. And the reason why a lot of things are just technical when it comes to the financial markets. And so sometimes you break one of these lines and it'll just go a lot farther, and it could quickly. But to break that line would mean the economy fell with it. It's just not like the line is causing it. It's just because we actually go into a recession, the banks sell off even harder. The Fed continues to raise rates. And so it's just like this horrible situation, which is likely to play out. And the sentiment hasn't changed a lot overall. We're sitting in the middle. We're looking for extremes to know like if we're too greedy or too fearful. And so we'll keep watching that. And next we're going to look at the spreads. So the spread between the triple B and the 90-day Treasury bill, we've looked at this over and over. It's still likely about the same. And as you know, unemployment rate typically follows this, and this is inverted. So once this corrects up, expect unemployment to go up. And we know that's likely to happen because companies continue to lay off every day. You hear about new layoffs. And this is a reminder, the market's actually not up 8%. It's up like a little less than 7%. But anyhow, that there are a lot of bull rallies in a bear market, 14%, 19, 28. And this is all considered quad 4. There's 4 quads, 1, 2, 3, 4. 1 is coming out of a bear market. We're in quad 4. I threw this one at the very end, and the reason why is U.S. imports have dropped off in 2000 recession, 2008, 2020, obviously, and now. And the thing that I found interesting was that in 2000, you look at the slope of this line, it's about 45 degrees. We're actually dropping faster. So what I'll probably do is like push on the imports, exports a little bit. We know in Vietnam and those countries that they were exporting less to China, and I did see some loan volume did pick up in China. So we'll see if we see some more on the export side as well. And here's the highlight of quad 4 investing, utilities, REITs, consumer staples, and consumer staples have been doing really well lately. And this is a simple methodology. Inflation's slowing, that is happening. Growth is slowing, that is happening. This is outside of equities, treasuries, and gold are core long allocations given yeah. So getting into this, maintaining buying power. So when I created this list, this is in Q4 of last year, was really to ignore the Fed. That was the goal of the list. And I did not expect tech to rally as it did, but it does make sense because if you look at the largest banks of the world that manage over $1 trillion or around $1 trillion, they only allocate to these big tech companies or big companies in general. So there's these pension funds, and they just don't, they're very highly concentrated, even though they, on paper, they're diversified, but it's big dollars they're moving around. And so they're not going to change their thesis that quickly. And if they're going to, if anything, they'll add to if the value goes down, because like Kathy Wood, she'll sell Tesla when it becomes 12% of her portfolio, then and take that and buy something else. And then when Tesla becomes 5% of her portfolio, then she'll start adding Tesla. That's how a simple rotational methodology. If you always sell your stocks that are like 15% of your portfolio and reallocate them to other ones that have 5%, but just don't make sure you're not allocating it to the losers though. So anyhow, maintaining buying power. Cash, obviously. Sell gold, silver, gold for store of value. And if QE is going to take place or any sort of fiscal stimulus, this will do quite well, gold, and gold is already doing well. So the market is telling you that the government is likely going to have to print money. And part of the reason is our interest payment on our debt is going to be up to $1 trillion here shortly. And when I say shortly, in the next like 24 months is my understanding. And once that is, it's so great. If our tax revenue can't offset that, then we'll have to find a way to raise that additional capital with more bonds. And if people don't want to buy our bonds, then we got to offer a higher rate of return on those bonds. So it just becomes a cycle. With us having over 30, we're at 31 trillion in debt in the United States. We're at a critical point where we need to pay down our debt. U.S. names, Warrior Met Coal, none of these, Valero, none of these change. Warren Buffett's guys in here. Excellent long-term companies, considering we're in an economic cycle in quad 4. You probably don't want to get too overexposed. Same thing, zip through here. And once the economy starts to look a little bit more healthy, I'll refresh this whole list. And for me, my definition would be healthy. Yield curve fixes itself, and at least I know that we're on the more normal road to recovery. And that is it for today. So the big picture, what's happening is inflation's dropped off. The Fed's likely going to raise rates one more time. They're getting pressure not to. So what's going to happen with the markets? The markets are going to, it depends on what type of valuations the market would like to give our U.S. stock market. It's probably not going to drop a lot, but I just don't see us staying at 18 just given the current state of the world, as well as, it just, to me, it doesn't make any sense. But saying all that, it doesn't matter. If there's enough funny money out there, you look at Venezuela's stock market, it's like straight up in 2022. So when there's a lot of money printing, stock markets go up. Look at Turkey, same thing. So that's why you have stocks like the S&P 500 index are great hedges to inflation. Owning real estate is a hedge, right? But you have to pay your taxes on it. If you hold in the stock and you don't sell it, there's no taxes. So you got to think about those things as well. But looking out the next 12 months, huddle down, like I've been saying for a while. And if you're a trader, be in and out, make some good money. Like I've been using Rocket Scooter, and that's why I've been spending so much time on lately. It's a great trading software that allows you to essentially, it looks at the market as a whole, assesses the liquidity, assesses where the flows are going, and it provides levels where you may or may want to put in on an investment, and boom, and you go from there. And it so far has treated me quite well in a short amount of time, and I'm not a trader. So thumbs up to that. If you have any questions or commentary, please leave it. Takeaway here is protect your cash. I've been saying it for a while. Yes, there's going to be 20% moves up and down. By the end of the day, you lose 50%. It takes 100% to get back up there. So it's better off waiting for a sunny day for many, many weeks, or at least for a few days before you go out there and risk hard-earned cash in these financial markets. And just watch Warren Buffett. Look at how much cash he currently has, and when he starts to deploy it, then you know it's time to like get active. And he hasn't been deploying very much lately, so he's a good guidepost to know what to do. And I appreciate your time. Thank you for tuning in, and hopefully the Fed won't raise rates after this next cycle, because we're getting up there, getting in dangerous territory. Thank you. Peace out.